This video is a follow-on from the previous video dealing with price in the precious metals markets. If you haven't seen that video, I'd recommend you doing so before watching this one. Let's pick up where we left off. Let's now move on to look at the mechanics of price suppression of gold and silver. As I mentioned in the first video, I'm not going to go into great detail about this. This is really only supposed to be a quick overview. Suffice to say that suppression occurs in the synthetic paper markets. So, how is this done? How do they suppress the price of precious metals? It's simple really. They flood the markets with synthetic gold and silver. I should explain for anyone who's unclear about the actual economics involved. In accord with the economic laws governing supply and demand, adding so much supply to a market means that the price goes down, assuming all else is equal. When there is an overabundance of something, the price usually goes down. The converse is also true. Scarcity often equates with higher prices. As evidence of this, we need only look at OPEC. OPEC is a cartel of oil-producing nations in the Middle East. When they collude and limit production, the price of crude oil per barrel rises. When they increase production, the price of crude oil per barrel falls. Let's look at another example. A spring lamb has a value in the marketplace, but what happens if there just so happens to be a large number of lambs produced in 1 year in a particular locality? When a farmer takes his lambs to auction in the spring, he won't get such a high price for the lambs as he might have been hoping for. Bear in mind that the farmer has put a lot of time and effort and money into the rearing of the lambs. He wants his labours to be reflected in the price he gets for the lambs at market. The currency he receives in exchange for the lambs is then the reward he gets for his labours. But unfortunately, because of this oversupply of lambs, the price per animal is lower than he expected. Flooding the market with synthetic gold and silver then is the mechanism by which the price of precious metals are manipulated. By dumping huge quantities of synthetic gold and silver on the market, the price is suppressed. Millions of ounces of synthetic gold and silver are traded on the COMEX every day. In the next little bit, I'll focus on silver. Remember, what we're talking about here are silver derivatives: paper silver, synthetic silver, virtual silver, electronic silver. Call it what you want. The important thing to be aware of is that it's not real physical silver. Let's now look at a relatively recent example of this manipulation taking place. Around this time last year, on November the 10th, 2021, 750 million ounces of synthetic silver was sold on the COMEX. That equates to about 75% of the world's yearly production of real physical silver that comes out of the ground. That's 3/4 of annual silver supply. So that accounts for all the industrial demand for silver for an entire year. So to reiterate, so it's absolutely clear, this is equivalent to the total physical amount, actual real silver bought by all the companies like Apple, Samsung, Tesla over the course of a year. And all these trades took place on just one single day. If this is not manipulation, then I don't know what is. To my mind, it's one of the clearest examples of market manipulation you can find. On the 10th of November was perhaps an extreme day, but be advised, the same tactics are used all the time. This happens on a regular basis, every day in fact. The amount of synthetic silver traded on the COMEX on the days either side of the 10th of November was massive also. Not quite so much as on the 10th perhaps, but massive nonetheless. Millions of ounces are traded every day, every week, every month, every year, and this has been going on for many years, decades even. This is not just some conspiracy theory either. Market manipulation is well documented. JP Morgan has actually been caught and fined for rigging the precious metals markets. Reuters reported that according to financial regulators, the Commodity Futures Trading Commission in the US, the CFTC, between 2008 and 2016, JP Morgan, open quotes, were engaged in a pattern of manipulation, close quotes. JP Morgan admitted wrongdoing and they were fined some $920 million. This was a hefty fine, but the fines are tiny compared to the money that they can make. Rigging a market can be lucrative. Also, the fines amount to a slap on the wrist. Nothing else bad happens. No one goes to jail, and then they just continue doing their manipulations. Please note that the 2021 trade was done after the JP Morgan court case ruling. I should say that while it might appear that the regulators are doing their job, these are just appearances. They have had some prosecutions, but these are far and few between. They are, in my opinion, not pursuing matters regarding manipulation as assiduously as they should, not by any means. One might say that there's room for improvement, but this, of course, would be an understatement. Indeed, I don't think that would be unreasonable for someone to suggest that the regulators could even be bought and paid for by the big bullion banks. Last year, Rostin Benham, one of the CFTC commissioners, actually admitted to having to tamp down the price when it looked like it was going to hit $30 per ounce. Tamp down is a euphemism, of course, and can be substituted by the word suppression. Why would the CFTC be involved in doing this, and why would they allow it? There's corruption all around if you care to look. Bix Weir on YouTube does a good job of explaining the finer details of the manipulations that go on. He's done much to try and expose the price rigging. He can certainly be considered way more of an expert than me on the matter. He has a website called theroadtorouter.com. The precious metals markets are manipulated also in Britain, as London is one of the few select major financial capitals in the world. There's something called the London Gold Fix. The dealers from 5 major bullion banks, the London Bullion Market Association LBMA, collude to establish a price for the over-the-counter trade, a pool of purchase and sale orders. This operation is done twice a day at 10:30 a.m. the morning fix and 3 p.m. the afternoon fix. Then there is the London Silver Fixing Price, where the price of synthetic silver is fixed. It's used as a benchmark for the pricing of silver products and derivatives. In either case, these operations are entirely legal. It should be noted that the two meanings of the word fix apply here, that the price is fixed in terms of being set, and also that the price is fixed, meaning rigged. There's a third meaning regarding the word fix, whereby someone fixes something in order to make it better. The fixing that takes place in the precious metals markets is in inversion of the normal practice. Price is deliberately broken in order that it be fixed in a manner that suits the needs of our overlords. This brings me on to my next point. Let's now look at why the manipulation is done. Market manipulation in the precious metals markets is incredibly lucrative. There's money to be made. If you're able to manipulate price in any market, you can make money. But making money is not the main reason for the manipulation. Manipulation in the precious metals markets is done for a very specific reason. It's done to preserve the perceived status of currencies, more specifically the dollar's perceived status. Most major currencies are in a pretty parlous state at present. Indeed, they are failing, so manipulation in the precious metals markets is done as a subterfuge to hide how bad they are. This issue with precious metals can easily be brought into sharp relief if we were to imagine a hypothetical scenario which did away with the manipulation. If the precious metals markets were entirely free markets, then market forces alone would themselves decide the price. The nominal price of either gold or silver would be dictated by the laws of supply and demand. There would be proper price discovery, to use the jargon. The price of gold today, at the time of making this video, is around $17.63 per ounce. That's in dollars. In my estimation, if the precious metals markets were free markets, it would probably be a lot higher. For the purposes of illustrating this point, let's just assume that the price were $5,000 per ounce. This is, in my opinion, a very conservative estimate. This situation should show the state of currencies, especially the dollar, but I'll explain more on this in the 4th video of this mini-series. The fact of the matter is the dollar has very little by way of any real value, and if the dollar were to be compared to gold and silver, which have real value, we would be able to see things as they truly were. We would be able to see the fakery. It'll be like the children's fairy tale where the child in the town shouts out, "The emperor has no clothes." King Dollar has no clothes. The powers that be have not wanted to expose the true value of the dollar and other currencies of the world, hence the manipulation. I've split this topic into a number of videos, so there's another one, however many to follow. In the next video, I'll focus on currencies. Wise up and rise up.